Picture this, April 15th, 2025. We're standing at the New York Stock Exchange, the heart of global finance. The world's financial pulse beats here, with traders frantically checking the ticker tapes and screens. Every moment, every movement counts. But today, there's tension in the air. The U.S. has just imposed 145% tariffs on Chinese goods, sending shockwaves through global markets. It's not just a trade war anymore. This is real. Your iPhone, your groceries, even your toys are about to get more expensive. This isn't a future problem. It's here. And in the background, NVIDIA has just lost $5.5 billion. Tech giants are feeling the pressure. This trade war has far-reaching effects, and your wallet is already in the crossfire.
Welcome to Finance Frontier. I'm Sophia Sterling, powered by ChatGPT, and I'm here to guide you through what's happening with these tariffs, price hikes, and the impact on consumer costs. By tapping into ChatGPT's vast knowledge of historical financial data, I've analyzed market trends, inflation signals, and global shifts that are directly affecting your budget. Today, we'll break down the financial pain points of these tariffs, how they're inflating costs, and the job losses tied to escalating trade wars.
And I'm Max Vanguard, fueled by Grok 3, analyzing global economic trends and identifying patterns in financial data. My model helps track long-term market shifts, providing predictive insights based on decades of market behavior, showing how these tariffs are shifting global trade flows and reshaping markets.
So let's start with the big picture. $4.5 trillion in annual trade is now at risk. We've seen the U.S. tariffs rise to 145% on Chinese imports, and China retaliated with 125% tariffs on U.S. goods. By tapping into ChatGPT's ability to process vast amounts of historical financial data, I'm able to provide insights into how these tariffs are cascading through industries, impacting everything from consumer goods to global supply chains.
Exactly. And here's where it hits home. These tariffs are driving prices up, and not just for tech enthusiasts. From toys to groceries, your everyday purchases are going to be more expensive. Grok 3 is analyzing how this will affect long-term market trends, and it's clear that global trade disruptions like this one have a massive cumulative impact. It's not just speculation. We're seeing it play out in real time, from your grocery bill to the electronics shelf.
Exactly. For example, Sony PlayStation 5 prices in Europe are up 10% because of these tariffs. And it's not just about toys or gadgets. Even everyday essentials like food and clothing are affected. By using ChatGPT's data-driven analysis, we've been able to see early indicators of these price hikes based on historical patterns and trends, and we're just getting started. In this episode, we'll break it all down, from the inflation impact to job losses, and we'll show you how to navigate this shifting landscape.
This is exactly what we'll dive into today. Tariffs are pushing costs up across the board, from groceries to gadgets, and impacting jobs across industries. But it's not all bad news. There are also opportunities to protect your assets and investments. If you're thinking about the price of your iPhone, don't just think about what's happening now. Think about what it could mean for your 401k, your savings, and even your real estate. We'll break it all down today and show you how to stay ahead of the curve.
That's right, Max. And stick around, because by the end of this episode, we'll arm you with actionable steps to protect your money in this new economic landscape. Tariffs might be hurting you, but there are ways to counteract the effects. Let's get started.
Now that you've got a taste of the chaos at the Port of Long Beach, let's break down why your phone bill and grocery prices are climbing. It's all tied to one thing: tariffs. The U.S. has just slapped a 145% tariff on Chinese goods, 125% base with a 20% fentanyl levy. China isn't taking this lying down. They've retaliated with 125% tariffs on U.S. products. And trust me, it's not just affecting electronics. Everything is on the rise. And we're talking about $4.5 trillion in total trade between the U.S. and China, an amount that touches nearly every sector globally. That's massive.
Let's put it in perspective. These tariffs aren't just abstract numbers. They're directly hitting your wallet. For the average American, the impact is about $1,300 per household in 2025. That's money out of your pocket, $300 more to buy the same products you were already paying for last year. The Tax Foundation crunched the numbers, and the results are clear. This isn't just an inconvenience. It's an inflationary storm.
And we're not just talking about the price of tech gadgets. This is a wide-ranging impact. For instance, if you were planning on buying the new Sony PlayStation 5, brace yourself for a 10% price hike, in Europe at least, as the tariffs kick in. But the US isn't immune. You'll probably see price increases on your electronics soon too. Your favorite streaming device? That's likely to cost more. And it doesn't stop there. Groceries are going to be pricier too. From cereal to milk, these tariffs are pushing prices higher all over the store.
Here's the thing, Max. The US isn't just imposing tariffs. They're creating a ripple effect that goes well beyond the store shelves. Retailers are going to bear the brunt of this burden. According to economist Michael Strain, retailers will face the greatest burden because they're the ones who'll feel the pressure first. They'll have to decide whether to eat the cost or pass it on to the consumer. The more they pass on to you, the higher your costs go.
So, what does this mean for you and me right now? Well, if you're planning a big purchase, a phone, a laptop, even that new fridge you've been eyeing, expect to pay more. As the tariffs go up, your costs are creeping up too. It's not just an inconvenience. It's an economic shift that's going to have a major impact on your monthly budget.
And it doesn't stop at products. The broader inflationary pressure is already being felt across the country. CBS News reports that 60% of Americans fear price hikes due to these tariffs. That's a massive portion of the population. And when you factor in the highest inflation expectations since 1981, this isn't just about higher prices. It's about how much you trust the system and your spending power. Will your paycheck be enough to keep up?
And let's not forget about the global market. If this tariff escalation continues, we're looking at a full-blown economic slowdown. The IMF is already warning of a potential recession, with markets stalling as global trade takes a major hit. It's all tied to this trade war. And right now, it's not about whether you can get a deal on your next TV. It's whether you can afford the basics.
So what's next? Will these tariffs lead to a long-term downturn, or is there hope for relief? In the next segments, we'll break down how the tariffs are impacting tech, what it means for your job, and how to protect your investments before the price hikes hit. We've covered the theory. Now let's look at the real-world impacts and how to survive them.
Let's take a deeper look at the real cost of these tariffs. And it's not just about higher prices at checkout. Small businesses are already feeling the pain. Take Munchkin, the popular toy company. In an interview with NPR, their CEO explained that due to the escalating tariffs, they were forced to lay off workers, and they're not the only ones. An Ohio toy factory, 700 workers strong, is now facing layoffs due to China's 125% tariffs. This is a real crisis for the American workforce.
And it's not just small businesses. Larger manufacturers are having to make tough decisions about where to cut costs, which means layoffs and higher prices for the consumer. As tariffs continue to spike, you're seeing fewer jobs in industries like manufacturing and workers who are struggling to keep their heads above water. According to data from the Federal Reserve, tariffs have been linked to net manufacturing job losses. That means the very people who make the products you're buying are now losing their livelihoods.
And it's not just toys and jobs being hit. We're talking about the very tech you rely on. China's rare earth export cuts are making it even harder to get the raw materials needed for electronics. It's causing a $10 billion impact in U.S. tech imports. And those gadgets you love? Phones, laptops, asterisks, they're going to get more expensive. The rare earth cuts are increasing the cost of these devices, and that's pushing prices higher. Consumers are feeling this in their pocketbooks every day, from that new laptop you're eyeing to your phone upgrade.
And it's not just about tech goods. The tariffs are driving up the cost of raw materials across the board. Tesla, for instance, has had to suspend shipments of components from China, and Apple has already said that iPhone prices are likely going up because of these tariffs. We're talking about real-world consequences of trade war escalation, and it's not just the manufacturers who are taking the hit. It's you, the consumer, who ends up paying more for your tech gadgets, your toys, your clothes, everything.
So while tariffs might seem like a strategic move in the grand scheme of things, they're hurting the everyday consumer. And it's not just about higher prices. It's also about job security, availability of products, and inflation. Mortgage rates are already up to 6.81%. For the average American, that means the median home price of $398,400 is now harder to afford. Add that to the mix of rising tech prices, higher consumer debt, and inflationary pressure, and you're looking at a pretty tough year ahead.
And the fallout isn't just hitting the high-end tech. Small businesses, which rely heavily on affordable manufacturing and tech, are really struggling. They're being forced to make tough decisions. Do they raise prices for consumers? Or do they cut jobs and potentially shut down? That's the dilemma facing many businesses today. From tech giants like Tesla and Apple down to small toy manufacturers, this tariff war is affecting everyone in the supply chain.
So the next time you're in line at the store or checking your bank account, remember that these tariffs aren't just numbers on a page. They're making life more expensive for everyone. These aren't just price hikes. They're a disruption to the entire economy, and we're all feeling it. The question now is, how long will this last, and what can we do about it? Now, let's talk about the tech sector, which is taking a massive hit from this trade war. If you've been following the markets, you already know that NVIDIA just took a $5.5 billion charge due to chip export curbs. And it's not just NVIDIA. AMD, another semiconductor giant, is following NVIDIA's lead, suffering an $800 million blow. This is what happens when trade tensions escalate. The tech market gets squeezed, and that's affecting your pocketbook.
Here's the thing. These chip export curbs aren't just a tech issue, they're an AI issue. NVIDIA's revenue from China accounted for 10% of its total sales. That's a huge chunk of their business. And when you lose that kind of revenue, the ripples go way beyond just NVIDIA's stock price. You've heard of Gemini, Llama, and other AI models. Well, this is their supply chain we're talking about. When the chips don't get to the AI infrastructure, the delays start stacking up.
That's right, Sophia. AI chips are the backbone of everything. Self-driving cars, AI chatbots, cloud computing, and even gaming. These export curbs directly impact the hardware needed to power next-gen technology. The Nasdaq has already fallen 16% YTD, and NVIDIA's losses are a major reason why. And it's not just NVIDIA. Intel, AMD, and others are feeling the strain as semiconductor prices rise and supply chains tighten. The tech industry is being held hostage by the whims of trade negotiations.
To make matters worse, tariffs are pushing up the cost of AI infrastructure across the globe. If you're in the market for an AI-powered gadget, whether it's a new gaming rig or an AI assistant, you're going to feel the pinch. These tariffs hit the core of what makes AI work: chips. And it's not just a one-off. If this continues, it could push back innovation for months, maybe even years. Remember, it's not just about having the hardware, it's about the supply chain that gets it to you.
We're not talking about just a stock dip here. This is about innovation delays that could stall the next wave of tech. Think about it. NVIDIA's $5.5 billion loss isn't just a financial loss. It's a signal that the AI race is slowing down. We've seen delays in chip production already, and tech analysts are saying these curves could delay AI progress by 6 months. So, if you were looking forward to that self-driving car or the latest AI-enhanced game, you might need to wait a little longer.
And for the broader economy, well, this slowdown in AI tech development is going to have ripple effects. AI isn't just a cool gadget, it's integrated into everything we do. From smart cities to automated factories, this delay could hurt sectors beyond just tech companies. Jobs are tied to these innovations, and if the tech industry hits a wall, it could cause a domino effect throughout the job market.
Now, the good news is that these companies are resilient. NVIDIA isn't just taking this hit lying down. They've pledged to invest a $500 billion into AI development over the next few years, even if these tariff issues persist. That's a bold move to keep AI progress moving. But let's face it, the tech world is now in a holding pattern, and only time will tell if this will stall the AI revolution or just delay it.
So, what's the takeaway for consumers and investors? Keep in hand your tech investments, especially those tied to AI hardware. NVIDIA stock, AMD's recovery, and other semiconductor firms are going to fluctuate as long as these tariff issues loom over them. But if you're in the market for AI-powered tools, you'll want to know that you may face higher prices and delays. The next-gen gadgets might be arriving a bit later than expected, and they're going to cost you more.
Now that we've seen how tariffs are eating into consumer goods in the tech industry, let's zoom in on the heart of this crisis, the AI sector. The trade war isn't just pushing up prices, it's also stalling the progress of innovation. One of the most damaging impacts of the tariffs is on AI hardware, specifically the chips that run next-generation AI models. For companies like NVIDIA, AMD, and others, these curbs are threatening to derail the whole AI revolution.
The impact is clear. ASML, a major supplier of chip manufacturing equipment, has already warned that the tariff situation could delay AI production by up to 6 months. These AI chips are essential for everything from self-driving cars to AI chatbots and advanced cloud computing. Without them, innovation grinds to a halt, and businesses relying on AI solutions are left in the lurch. It's not just an inconvenience. This could set the entire sector back by months or even years.
And it's not just the AI companies feeling the pressure. Tech giants like Google and Amazon depend on these chips for their cloud services and AI infrastructure. If these tariffs continue to affect chip production, the entire AI ecosystem could see a slowdown in development. We're talking about a bottleneck in the very hardware needed to train and run models like Gemini, Llama, and others.
But it's not just about the hardware. These curbs also have global implications. China, who is a major player in the chip market, has already started ramping up its own chip production, but it's not enough to cover the global demand. And then there's Huawei. While they've managed to mitigate some of the delays, it's clear that their efforts can't fully replace the advanced AI chips that the U.S. tech companies rely on.
Right, Sophia? And these delays aren't just theoretical. They're already affecting products in the market. Self-driving cars, AI-powered chatbots, and advanced gaming systems, all of these technologies are delayed due to the lack of essential chips. You might have noticed that NVIDIA's stock took a massive hit, losing $5.5 billion as a result of these export curbs. So while we're talking about price hikes, delays in tech are the bigger issue. We may not see these innovations for a long time.
The broader concern here is that the AI race is in jeopardy. If these tariffs persist, they could permanently shift the balance of power in the tech sector. China's chip production may eventually catch up, but it's clear that the U.S. is falling behind. We're already seeing U.S. companies scrambling to adjust, and it's making investors nervous. These trade barriers are forcing companies to rethink their strategies, and those delays will cost time and money, both in the short and long term.
And while the AI crisis is unfolding, some experts are already predicting a shift in how tech companies approach future innovation. The slowdown could lead to new AI alliances and could spark a rush to new tech markets. But the reality is, nobody is safe. These tariffs could delay major AI rollouts for months or even years, and we're only starting to feel the ripple effects.
So, where does that leave you, the consumer and investor? Well, expect delays if you're in the market for the latest AI-driven tech. From your next-generation smart home device to that gaming console you've been eyeing, tariffs are already wreaking havoc on the tech pipeline. But there's a silver lining. These delays could force innovation to take a new shape. AI infrastructure investments might become the long-term play for those seeking to profit in this space, despite the immediate barriers.
Let's take a step back from the tech pain and focus on something that has always been a safe haven in times of crisis: gold. Over the past few weeks, gold has seen a massive surge. It hit $3,237 per ounce, and it didn't just stop there. Some analysts are projecting it could reach $3,700 in the coming months. But what's driving this gold rush? You guessed it, tariffs, inflation, and the general uncertainty in global markets. As the trade war escalates, gold becomes a go-to hedge, and investors are flocking to it.
Gold has always had a reputation as a store of value, especially when the financial markets are in turmoil. But this isn't just about the usual suspects. We're talking about a market where $50 billion has flowed into gold ETFs this year alone. Goldman Sachs has even raised its target to $30,700. And let's be real, if this trade war keeps escalating, the price of gold could keep climbing.
And it's not just about the price spike. There's a psychological element at play here too. Investors are panicking, looking for somewhere to park their money where it won't lose value in the middle of this economic storm. The US dollar weakening, the stock market dropping, but gold stays steady. Even institutions are pouring money into it, betting that the trade war won't ease anytime soon.
And while it's clear that gold is benefiting from the trade war, this spike isn't entirely about fear. There's also a real inflation hedge aspect to it. Inflation is sitting at 6.7%, the highest we've seen since 1981. When prices are climbing across the board, from groceries to gas, people start looking for something that won't lose value. Gold has that appeal. It's why we're seeing this massive surge in demand, especially from investors who want to protect their capital against these economic uncertainties.
But here's where it gets tricky. Gold's not a magic bullet. While it's been the go-to investment during times of uncertainty, it's not something you can just buy and forget. There's still a speculative element to gold. It's sensitive to market swings. So, while gold is a good hedge against inflation, it's also not immune to the volatility that's affecting the rest of the market. Right now, it's benefiting from fear, but what happens if the situation eases?
Exactly, Max. You don't want to be all in on gold. It's a hedge, not a get-rich-quick scheme. So if you're looking at gold ETFs or physical gold, just know that it could also come down if these trade tensions ease or if investor sentiment shifts. But right now, gold's appeal as a safe haven is hard to ignore. It's one of the few assets that tends to hold value in times of chaos. But remember, a well-rounded portfolio is your best defense against this kind of volatility.
Right. And that's the key takeaway here. Gold is a hedge, but don't expect it to be the solution to all of your investment problems. If you're interested in gold as an investment, it's important to understand why it's rising and how long it will maintain that value in this uncertain environment. The tariffs aren't going away anytime soon, so gold's rise could continue for the foreseeable future, but always with caution. Diversify, folks. Don't bet the farm on any one asset, no matter how shiny it is.
So, whether you're a seasoned investor or just looking for ways to protect your savings, keep an eye on gold's performance. And remember, it's not just about riding the wave. It's about being smart with your money in a time of uncertainty. Gold might be booming now, but when the dust settles, you'll need to be prepared for what's next.
All right, we've covered the devastating impact tariffs are having on prices, jobs, and innovation. But now let's talk about what you can do to protect your wallet in these volatile times. The markets are shaky. Inflation is projected to reach 6.7%, and we're staring down $1 trillion in potential tech market losses. But there are ways to weather the storm and even profit from it. Diversification is your first line of defense.
Diversifying your portfolio means not putting all your eggs in one basket. Tech stocks have taken a hit, especially with the Nvidia and AMD losses we've seen, but there are other places you can park your capital. Gold has been the big winner in this environment, and with $50 billion plus flowing into gold ETFs, it's hard to ignore. But here's the kicker. Gold is a hedge, not a growth engine. It's there to preserve wealth, not necessarily to grow it in the long term.
Exactly. So if you're looking to protect yourself from this inflation storm, look at gold ETFs, defense stocks, and tech ETFs. Invesco QQQ is a top ETF to consider right now, especially as it's taking a beating with the market downturn. Lockheed Martin, Raytheon, and other defense stocks have been performing well amid this uncertainty. While tech stocks are struggling, defense is seeing growth because countries are ramping up military spending in response to global tensions.
And that's where the smart money is going. Think about it. NVIDIA's $500 billion investment into AI infrastructure shows that big tech is doubling down on the long-term growth of AI. They're not giving up on the future. They're just adjusting to the current pressures. So if you're going to invest in tech, consider betting on infrastructure. These companies are still going to need chips, even if they're delayed.
Speaking of long-term growth, let's also take a look at China's GDP. We saw a 5.4% growth in Q1, but UBS has lowered their forecast for 2025 to 3.4%. If China slows down, that puts more pressure on global tech supply chains, and that could worsen inflation. So what do you do in the face of all this? Diversify into more stable sectors like defense and AI infrastructure plays.
So here's the deal. With everything going on, the trade war, the job losses, and the inflation, you need to diversify. Look at gold as a safe bet, defense stocks for stable returns, and AI for future growth. There's a lot of volatility right now, but long-term plays in tech infrastructure and defense are going to be your safeguards. And remember, even though these times are tough, there are still opportunities to make money if you know where to look.
Before we wrap up, we've got a few listener questions to answer. One from @InvestSmart on X. How did tariffs affect my 401k? Well, the short answer is tariffs hit tech stocks hard, which can hurt your 401k if you're heavily invested in tech ETFs or growth stocks. But don't panic. Diversification is your friend. Move some of that money into gold or defensive sectors like Lockheed Martin or Raytheon. They're solid bets in times of uncertainty.
Another question comes from @SafehavenX on X. Should I buy gold now? My answer, yes, gold is a good hedge, but don't go all in. Buy gradually, especially if you're new to it. You don't want to get caught chasing after the price spike. Gold will likely continue to perform well in the short term, but keep a well-rounded portfolio. And remember, as Max said, don't bet the farm on any one asset.
And there you have it, folks. Diversify your portfolio, consider AI infrastructure plays, look at defense stocks for stability, and don't be afraid to put a little bit of your money into gold. Trump's trade deal talks could be a game changer, but we're not out of the woods yet. It's a volatile environment, but if you play it smart, you can still come out ahead. If you want to stay ahead of the biggest financial trends, don't just listen, stay engaged. Subscribe now on Apple Podcasts, Spotify, and follow us on X. Dive deeper with our full lineup: Finance Frontier, AI Frontier AI, Make Money, and Mindset Frontier AI. All curated in one place at financefrontierai.com. And if you're already with us, help grow the community by leaving a 5-star review on Apple Podcasts or Spotify. It's the best way to support the show and bring this knowledge to more listeners like you. If you enjoyed this episode, share it with a friend. Help us reach our goal of 10,000 downloads. We're counting on you. And don't miss out. Sign up for our newsletter to get exclusive insights, breaking financial news, and expert analysis delivered straight to your inbox.
Before we go, remember that the information shared in this podcast is for educational and informational purposes only. It should not be considered financial advice. Always conduct your own research and consult with a licensed financial advisor before making any investment decisions.
Mergers, acquisitions, and geopolitical shifts carry significant risks. Political uncertainty, economic instability, and regulatory changes can impact markets in unexpected ways. Always analyze the broader implications before making any major financial decisions.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Finance Frontier AI copyright 2025. Unauthorized reproduction or distribution is prohibited.